Good morning, everybody. It's Wednesday, July 10th, 5:27 a.m. Central Time. Grain market's a little bit lower this morning. December corn futures down 2.25 at 406.25. November soybeans down 2.5 at 1077.5. December Chicago wheat down 3.25 at 592.25. December Kansas City wheat down 5.25 at 591. December spring wheat down 1.5 at 634.75. Let's kick it off with the soybean sell-off.
So, soybean futures posted fresh lows on Tuesday. The November 24 contract lost nearly 20 cents to close at 10.80 per bushel. This was the lowest close for the contract since the third quarter of 2021. A sharp decline in soybean oil values paired with a more modest decline in meal helped spur the sell-off. Current prices imply a loosening U.S. supply and demand situation. Many traders are working with the idea of a trend or better national U.S. soybean yield given weather and crop ratings. The demand side of the balance is perhaps the balance sheet, is perhaps an even larger concern. The book of new crop U.S. export sales is the worst in 20 years. Export sales are projected to account for 42% of all demand for soybeans grown in the U.S. next year.
Soybean market, corn market acting very, very poorly. The chatter regarding above trend yields is out there, and it's getting a little bit louder. Could the national corn yield be 182, 183, 184? Could the national soybean yield be 53, 54 bushels per acre? I know those are tough pills to swallow, given some of the things that we've seen on the weather front this year. We saw flooding in the Western Corn Belt. We had this hail event recently. But I'll tell you what, the rainfall situation has been adequate. These rains that are, we're going to do weather in a second, but the rains that have pushed across as a result of this hurricane are ideal in timing and also in placement. So on the supply side, the trade is optimistic regarding crop prospects. I think the demand side is a bigger problem. I don't know what the yields are going to be, but I know that demand sucks. The book of export sales for beans, new crop, as Mackenzie mentioned, is the worst in 20 years. China hasn't bought a single cargo of new crop U.S. corn or soybeans. We're going to have great demand on the processing front. Ethanol production is going to be great. Soybean crush is going to be great. It's just not going to be enough as it stands right now to offset big crops and poor export demand. So the markets right now, I think, are seeking a price that stimulates additional demand on the export front in particular, and we just haven't found it. Let's go on to weather.
Rainfall associated with Hurricane Beryl covered a wide band of the central U.S. this week. In regard to the Corn Belt, Missouri, Illinois, Indiana, and western Kentucky saw the best amounts and coverage. The radar is active again this morning as the same system continues to push across Illinois, Indiana, and into Ohio and Michigan. The forecast is largely dry following the Beryl-related rains. Temperatures will run back and forth above and below normal during the next 2 weeks, although the 6 to 10 and 8 to 14 day government maps favor the odds of above normal temperatures.
To go back to recent rainfall, last 72 hours, these rains, again, associated with the hurricane, are timed almost perfectly. The placement is ideal given where had been dry. Some of these areas had been drying out, a little bit of drought on the drought monitor in some of these areas of the Eastern Corn Belt. And they're catching rain, and they're going to catch a little bit more. It's on the radar again this morning. It's kind of moving its way north. A lot of this stuff in the 10-day forecast is actually just going to be the next 2 or 3 days, and then we're going to dry out a little bit. Maybe given a drier forecast now following this big soil moisture charge paired with the heat, maybe that's an issue for soybeans at some point. I'll tell you this, though. I know that people will say, and traders will say, the soybean crop's made in August, right? And, yeah, maybe that's the case. I've just never personally seen I've never seen soybeans, the market. I've never seen the soybean market relate to August weather the way that corn acts to June, reacts to June and July weather. The corn market reacts acutely to changes in the weather forecast in June and July. I just never seen it work that way as it relates to August and soybeans. They don't seem to move in tandem the way that they do in corn. But for right now, I mean, this system, again, this big hurricane-related system is considered to be very, very bearish, and that's why they've taken so much out of the markets this week.
So if you guys haven't checked out our premium content, you sure need to do so. You won't find content like this anywhere else. Joe, can you tell me about yesterday's premium video?
So the funds, or large money managers, are record net short the corn market. They're very heavily net short the soybean and wheat markets. I talked about funds versus farmers. That was the title of the video. I think there's a lot of misinformation out there regarding what the funds are, who they are, what they actually do. And what I did in this video is a number of things. We did some overlay charts, fund position versus history in terms of price action. Also talked about just how big the net long is that the farmer is holding versus the net short that the funds are holding. I think the people are looking for somebody to blame for the price action. It's the funds, it's the bricks, it's the government, it's supply and demand, guys. That's what it is. It's supply and demand. There's nobody's out there to get you. It's just these markets are cyclical. But this video focused specifically on the funds. I think this is a really good watch, and I think a lot of people had some positive feedback on this one. Go to standardgrain.com, sign up this morning. I'll forward you a copy of this morning's email, which includes that video. It also included a PDF download with a bunch of charts that were included in the video. This is a $50 per month subscription. You can cancel at any time. No other fee, no other obligation. Nobody will try to sell you anything else. Just a ton of information, actionable information from us every single business day, guys. Give that deal a shot this morning.
Indian imports of Russian agricultural products have spiked. During the 23-24 season, India imported 22 times more Russian grain and grain products than the previous season. At the start of the year, Russia accounted for a third of India's fertilizer imports. According to a Russian agricultural watchdog, the surge in Russian imports was mainly due to an uptick in pea and lentil imports. Russia exported 89.3 million metric tons of grain and grain products during the 23-24 season. Those exports were up 21% over the prior season and included a 31% increase in corn exports.
The story here, or what could be the story, is that India may import wheat. Domestic prices are higher. They've got, I'm not going to call it a shortage, but they may need to import some wheat. And if they do, given this relationship, it may be from Russia. And again, people will look at this story and say, oh my gosh, the BRICS are the bad guys, and that's why we're losing money this year. I don't think it's that. I think it just, again, goes back to supply and demand. Russia's the biggest wheat exporter. If India is going to buy it, it makes sense for them to buy it from Russia, and that's probably what happens.
Oil prices tumbled by more than 1% on Tuesday. The decline was due to Hurricane Beryl causing less damage than anticipated. Traders were expecting supply disruptions due to the storm. WTI crude fell 1.1% to 81.41 per barrel. Remarks made by Federal Reserve Chair Jerome Powell on Tuesday regarding the slowdown in the jobs market and the economy also had an effect on oil prices. Additionally, oil prices fell on the possibility of a Gaza ceasefire.
We haven't talked about crude in a little while because it's been very quiet. I mean, we've seen some back and forth. You know, you'll be up for a couple of weeks, you'll be down for a couple of weeks. But generally speaking, WTI has been kind of confined to this, I don't know, call it 75 up to maybe mid 80s type range for the majority of the calendar year. Bloomberg Commodity Index, we haven't done this one in a while either, has been very much sideways. It's actually impressive that it's not worse given the big collapse in grains, which represent 23% of the index. But, you know, energies have been more sideways. Some of your metals have actually acted really well. But the commodity market itself as a sector, there's no excitement here at all.
So, as I just stated on Tuesday, Fed Chair Jerome Powell said that the slowdown in the jobs market is just as dangerous to the U.S. economy as high inflation. The Fed is now under pressure to begin cutting rates because of the slowdown. Powell, however, did not offer a timeline for when rates would be cut. Instead, he reiterated that before rates can be cut, the Fed needs more evidence that inflation is moving toward its goal of 2%. Following Powell's statements, the S&P 500 hit its 36th record high for the year, settling at 5,577.
So we've now got 70% odds of a September rate cut, given how the interest rate markets are behaving. Stock market posted a fresh all-time high yesterday. This is pretty dovish stuff from Powell. I've got a couple quotes here. He said, elevated inflation is not the only risk we face. We've seen that the labor market has cooled really significantly across so many measures. It's not a source of broad inflationary pressures for the economy now. For a long time, the risks were that we would fail to hit our inflation target. Increasingly, the risks between allowing inflation to remain too high and allowing the labor market to slow down too much are coming much more into balance. We're very much aware that we have two-sided risks now. This is about as dovish as he's going to get. So the S&P posted fresh all-time highs again yesterday. It's up 17% year to date. It's up 155% from the COVID low that was posted in 2020. So the stock market loves this. A lot of businesses, I guess, are going to love a lower rate environment. I don't know that rates on the long end have to come down necessarily. I still think the bond market has problems. but I guess we're going to see a cut in September the way that it looks. We're back and forth, though. Nothing's a guarantee. What did cattle do yesterday?
It was an ugly day for cattle futures yesterday as they likely responded to boxed beef falling out of bed. Feeders were down an average of 292. Live cattle were down an average of $1.52. As I just said, boxed beef had a terrible day yesterday. Choice end of the day at 325.66, down 481, and select end of the day at 304.31. That was down 41 cents.
Outside markets, U.S. dollars about flat. Stocks are mixed. Bonds are up a little bit. Gold's up $14. Crude oil is up 4 cents in the August WTI at 81.45. Have a great day, guys. We'll talk to you on Thursday.